So far, so good. We have completed operating statements. We have also discussed relevant costing principle. So in today's class, we are going to be dissecting short-term decisions. During the course of this class, we are going to discuss the meaning of short-term decisions. We will talk about marginal costing concepts briefly. Then I will tell you the meaning of decision making, the perspectives of decision making, and finally, during the course of this class, I will tell you or I will demonstrate the areas of application of marginal costing technique. So let's take it one by one. What do you understand by short-term decisions? The short-term decisions involves the uses of marginal costing concepts and relevant costing principle to analyze a particular course of action in making managerial decision. For this purpose, we can say marginal costing technique involves the process of comparing the benefits or cash inflow arising from a course of action with its associated relevant cost. The marginal costing concept is also known as cost-benefit analysis, in that management may want to know whether the benefits arising from a course of action will outweigh its relevant cost. Therefore, under short-term decisions, relevant costing principle will be used in conjunction with the marginal costing technique in analyzing a particular course of action for the purpose of making a decision relating to the course of action. So we can say relevant costing principle represents the costs that are directly attributable to a particular course of action in making a decision. That is, relevant costs represent the costs that can influence or that will have material impact on the decision that is to be made. Any cost that will be incurred purposely as a result of the decision that is to be made is what is known as relevant cost. So under short-term decisions, the marginal costing concept and relevant costing principle will be used together to analyze the course of action in order to make a decision. Generally, decision-making involves the process of selecting a course of action from among different alternatives. Hence, the decision of this nature will be examined critically under two perspectives, including the economic perspective and two, the qualitative perspective. Let's take it one after the other. What do you understand by economic perspective? The economic perspective, also known as quantitative and then quantifiable perspective of the decision that is to be made. It involves the process of determining the economic and financial viability of a course of action in order to determine whether it will result in a contribution or profit or loss, or saving or deficit to the organization. That is economic perspective. The qualitative perspective, also known as non-monetary, non-quantifiable, non-economic aspect of the decision that is to be made. The qualitative factors represent the factors that cannot be expressed in monetary terms. Essentially, the quality of the decision that is to be made will have far-reaching effects on the success of the business in the marketplace. This is because bad decision or a bad decision can limit the ability of a company to take advantage of market condition. Bad decision can result to financial losses to the organization. Not only that, a bad decision being made can erode the reputation of a company. Therefore, it is vital that the decision of this nature or the requisites or designated decision makers should be allowed to make the final decision. And the decision-making process should be brought to the attention of the decision maker in order to receive appropriate guidance and to avoid any wrong decision being made. And that's why it is important you allow the decision maker to make the final decision. As a management accountant, you have responsibility in this regard to provide recommendation to the management. Your work or your responsibility may include to make a suggestion or to provide expertise to the management and allow the final decision maker to make the final decision. Because if you as a management accountant make an error that results to financial losses to the organization, the consequential effects may be material. And that's why it is important that you allow the decision maker to make the final decision. All right? Good. Now, what are the areas of application of marginal costing technique? What are the areas of the application of marginal costing technique? There are several areas in which marginal costing concept can be used to aid managerial decision. Marginal costing technique is a concept that is designed principally to aid managerial decision. When it comes to decision making, the knowledge of marginal costing concepts will be essential to support management in making a decision. Therefore, what are those areas where marginal costing concept can be applied in decision making? One of the areas in which marginal costing concept can be used is what is called, let's put it down. We can use marginal costing concepts when there is a decision to be made on deleting of a segment. Okay? Let me put it down. Areas of application of marginal costing concept. Okay? Number one, deleting of a segment. Okay, deleting of a segment. We are going to discuss this in our subsequent class. All right, deleting of a segment will arise if a particular segment is operating at a loss. Management may be thinking of closing down the segment. All right, so the decision to close down or not to close down would depend on the two perspectives, which we discussed earlier on, the qualitative and the quantitative perspectives. So when we get there, I will explain to you what deleting of a segment is all about. The second area where marginal costing concepts can be applied in decision making is make or buy decision. Okay, make or buy decision. Number 3, now, under make or buy decision, oftentimes management may be contemplating on whether a particular raw material, sub-assembly, or component required for the manufacturing of the company's final product should be produced internally or contracted to an outside supplier. This kind of decision is very critical and strategic because of the need to protect the degree of secrecy underlying the company's product. Therefore, management wants to know whether they should make or buy the component. All right? So we are going to discuss that separately as we proceed during the course of this class. The third area of application of marginal costing concept is where there is acceptance, the need to determine the acceptance or rejection of a special order. Okay? Again, it's all about decision making. Management may want to know whether a one-off order should be accepted or rejected. The decision to accept or reject the order will depend on whether the special order will result to additional profit or loss to the organization. Again, we are going to discuss this separately as we go on during the course of this class. Number 4 area that we are going to discuss areas of application of marginal costing concepts is shutdown of capacity. So management may want to know whether a particular capacity should be shut down or they should continue with it. Shutdown of capacity. Okay. Then number 5, you can also use the concept of marginal costing technique when there is need, when we are on adding of a new segment. Okay, where there is need to add a new segment. Management may want to know whether a new segment should be added or not. Then number 6, you can use marginal costing concepts in pricing decision. Okay, in pricing decision, you want to know what price to charge for your product or for a service. All right, should we use skimming pricing? Should we use penetrating pricing, full costing, marginal costing? All of this. Of course, pricing decision is a topic on its own in performance management. So we are going to discuss this separately. Another area where you can apply the technique of marginal costing in decision making is optimal product mix decision. Okay, optimal product mix decision. The optimal product mix decision will arise where a company does not have sufficient factor of production to produce the company's final products. Therefore, the little that the company has, how is going to be allocated among competing product line in a judicious and efficient manner is what optimal product mix decision is all about. Of course, the optimal product mix is used when there is only one constraint, where only one factor of production is limited in supply. So optimal mix is a topic on its own. We are going to discuss it when we get there. Number 8 of the areas of application or uses of marginal costing concepts is linear programming. We can also use the concept of marginal costing in linear programming. Okay, linear programming is closely related to optimal product mix, only that the linear programming is used when there are multiple constraints. When you have more than one constraint, then of course linear programming is used. And linear programming is also based on the efficient and judicious allocation of limited scarce resources. Okay. Then finally, the another areas you can apply marginal costing concepts is cost, volume, profit analysis. Okay, we can apply the use. We can use marginal costing concepts to analyze cost, volume, profits. Okay, so these are some of the areas in which the marginal costing concept can be used to aid managerial decision. Okay, so like I said, in this class, under short-term decisions, our focus will be on the deleting of a segment, make or buy decision, and then the acceptance or rejection of a special order. Every other areas of the application of marginal costing will be discussed separately as a topic on their own. Okay, so the next thing we are going to do now is to discuss what do you mean by deleting of a segment? What are the economic and then the qualitative factors to be considered under deleting of a segment? What is the decision rule as far as deleting of a segment is concerned? So that will be in our next class.